Well, according to market data from research firm Tracxn, venture capital inflows have fallen 40% in the first 9 months of 2025. They've dropped to $2.7 billion from $4.5 billion last year. In fact, large checks have virtually vanished to only two rounds above $100 million this year compared to nine a year ago. My colleague Jude Saneth is now here joining us with more insights from this particular report. Jude, so what's really led to the steep funding slowdown? We were given to understand that at least early stage startups are getting this sort of funding, and of course the funding winter that the industry was facing about 24 months back and 26 months back, that has dissipated.
Well, you heard that right. A whopping 40% drop in VC funding in the first 9 months of 2025 has plagued tech startups in Bengaluru, according to the latest market data from research firm Tracxn. Now, these startups, Tracxn's report says, raised a total of $2.7 billion between January and September, in stark contrast to $4.5 billion last year. In fact, a large chunk of these funds was raised in the first half of the calendar year. That's around $1.7 billion, still a 44% drop when compared to H1 of 2024 and 30% lower than the second half of last year. Of the $2.7 billion raised so far this year, seed stage funds were approximately $141 million, early stage funds were around $611 million, and late stage funds lay in the range of about $930 million. Now, here's where funding this year has struggled, according to Tracxn. It's the large rounds that have taken the biggest hit. The report says funding rounds above $100 million shrank significantly. Only 2 of them took place within the first 9 months of 2025, compared to 9 such rounds in the same period last year. IPOs dropped too. There were just 2 IPOs in January to September, compared to 6 IPOs in the same period last year. So the question that's on everyone's mind is simply this: why has there been a drop in funding through 3/4 of 2025? It's been largely attributed to a collapse in large and late-stage rounds and a marked reluctance by investors to write out big checks. This is largely reflective of a noticeable shift in investor sentiments and well-documented cautiousness in late-stage private equity.
All right, so investor reluctance as far as writing big checks is concerned. So definitely there are deals happening in the startup ecosystem. There is funding happening, but it's not so much in the late stage startups as it is in early stage startups and seed funding. Well, that was my colleague Jude putting the story into perspective. But let's now move on and take a look at what else is coming up on the show. Well, AdvantEdge's first fund has delivered 11.5x multiple on invested capital. That's supported by liquidity events across its mobility and transport tech portfolio. The fund has already returned over 3x TPI to its investors. In fact, a recent partial exit from Rapido generated an estimated 111x return on the company's 26 investment. There is additional value also that has been unrealized value that it's expected to accrue across the remaining portfolio. Joining us now to talk about that and about the investments in the mobility space is Kunal Khattar. He's the founding managing partner AdvantEdge Partners. Thank you very much, Kunal, for taking the time out and speaking to us here on ET Now. Now, speaking of your company, well, Rapido has become the largest contributor to AdvantEdge's Founders Fund 1. You also have other investments in the mobility space. Are you anticipating a similar outcome?
Absolutely. Thank you so much for having me. So this is the power law that sort of is in play in technology funds. So we've been very fortunate to have backed Rapido right from the beginning. But it was more a thesis-driven approach rather than sector agnostic. And the reason for that is that we are a sector-focused fund, unlike others, and therefore we have no choice but to invest in opportunities across the mobility space. And for us, shared mobility was an opportunity we identified in 2015. But unlike Uber and Ola, we decided to back Rapido because it was building a more affordable platform, focusing on 2-wheelers rather than 4-wheelers. Fortunately, today, Rapido has now become bigger than both of those companies. So we are fortunate to have been to return a fund with an 11.5x MOIC. So we're very happy to do that. More than that, Rapido's created almost 10 million jobs in the gig economy. So that's something that we're proud of as well.
Absolutely. Absolutely. Kunal, so like I was stating that you have other investments in the mobility space as well, and you're looking at similar outcomes. So where will growth come from as far as the mobility space is concerned? Because we are seeing several verticals come up, several different segments come up in this space.
We are looking at least four distinct verticals across the auto industry. So shared mobility was a focus area for us in Fund 1. In Fund 3, we've actually picked on the transition from ICE to EV as an area that we want to focus on now, which according to our rough estimate is actually $1 trillion of wealth creation opportunity that's available to us if we were to mimic what happened in the ICE or the internal combustion value chain that was created when Suzuki came to India and launched the Maruti product. So we're looking at investments across the entire EV infrastructure space, prioritizing commercial form factors over personal mobility because commercial vehicles, even though they're just 10% of the car park, actually consume 70% and hence provide 70% of the pollution to India. So if we're able to electrify that small 10% of the vehicles, we can actually reduce our energy consumption and reduce vehicular pollution by 70%. But because it's a small volume, majority of the capital has gone to companies like Ather and Ola Electric, which is a 9x TAM. But as a fund, we think we can deliver better or superior return on capital by focusing on commercial form factors.
Right, but you're talking about commercial form factors, Kunal, but are we entering a new phase where micro-mobility and last-mile transport are being seen as more scalable than traditional mobility startups?
The last mile mobility, which areas like food delivery or quick commerce is one of the fastest growing sectors, but that's 100% commercial form factor use case, right? Whether it's middle mile logistics, intercity travel, public transportation, or the entire ride hailing platforms like Rapido, Uber, and Ola. They are today a majority of these services are being provided using traditional ICE vehicles. Now, one of the interesting points we have to see is that the cost per kilometer in India, 70% is the fuel cost because, petrol and diesel is taxed very heavily. So actually, you get the maximum operating leverage if we're able to move our diesel and CNG vehicles to electric. And that's the area that we're really focusing on.
Right, Kunal, but you're also coming up with the new Fund 3 as well. What are the kind of investment opportunities that you're looking at besides the mobility space?
We've identified about 14 or 15 investment opportunities. The focus, again, is more on the electrification side, but we are also looking at adjacent areas that includes the use of UAVs or drones in civilian and defense purposes. We are actually identifying and seeing a lot of opportunities more on the energy side, whether it's energy storage, etc. Because we see as we move more and more towards renewable energy, there is an opportunity to build businesses that's able to sort of fuse or merge the generation of renewable energy with the needs of electric or electric vehicles. So those are definitely areas that we're looking to focus on and continue to build our thesis.
Right, Kunal, but what mobility subsectors are you seeing attracting the next wave of investment? Is it going to be in EV infrastructure? Is it going to be in two-wheelers, shared mobility, logistics, or something else that you're looking at?
All of the above. So if I were to pick all the commercial vehicles that we need to electrify, like you mentioned, in the last mile, we need micro scooters that can help us deliver a pizza or quick commerce in an efficient way. We need middle mile logistics that can help us, build electric three-wheelers. Public transportation, starting from the humble three-wheeler to buses, all of them need to electrify. So there's a need to build form factors, finance solutions, leasing solutions, battery as a service or energy as a service solutions. We're also looking at intercity travel as one of the biggest opportunities within those areas as well. So it's all the form factors, right from the slow two-wheeler right to commercial buses and trucks are what we're looking at. And I think if we're able to build the necessary foundation or fill the gaps that today need to be done, we'll be able to, in a far more capital efficient way, transition away from ICE to EV. And once you've electrified commercial form factors, that same infrastructure can be used and leveraged to electrify personal mobility in a far more efficient way rather than continuously keep giving subsidy to encourage individuals to buy electric vehicles. So I think that's a far more intelligent way to do that.
Right. Right. Kunal, just one final question before we let you go in. This is essentially about the cabinet clearing over 77,000 crores of scheme for manufacturing of rare earths in the country. This has been in the offing for a very long period of time. The government was planning it. How are you seeing it? Is this going to be sufficient for India to reduce its reliance on China?
We absolutely have to build our entire end-to-end capability. And as we see the adoption of electric vehicles go up, we are seeing the need for us to become more self-sufficient with regards to rare earths, because we need them both for battery as well as motors. So I think whatever investment that the government is making is going to go a long way to do that. But with deep technology and R&D, it's a timely and time-consuming process. I think we have the capability, we have the talent, and we are seeing that there is a lot of capital infusion and focus on R&D. And hopefully, we actually have a couple of our portfolio companies that are focusing on manufacturing rare earth-free motors, for example, to reduce that dependence. So it's not going to happen overnight, but I think if we are building and we are seeing a comprehensive roadmap that's being built, and now we're in the process of executing it, I think it's the right way to go. And we're pretty excited about seeing what kind of opportunities policies like this are going to unfold for a fund like us.
Absolutely, Kunal. Thank you very much for taking the time out and speaking to us on ET Now. This is definitely a big move by the Indian cabinet. The industry had been asking for it for a very long period of time. Then, of course, we were also looking at several other partners across the globe to reduce our dependence on China for rare earth materials. But ladies and gentlemen, final story on the show, and this one is coming in from the big tech segment. Well, Google's parent Alphabet is well on track to hit a new milestone. The tech giant is all set to join the premium league of companies with a valuation of over $4 trillion. But which are the other companies which are already in the club, and what's driving Alphabet's rally? My colleague Shibani is now joining in with more details. Shibani?
Forget million, billion-dollar companies. Forget trillion-dollar companies. Right now, 4 of the most powerful tech titans are battling in a league of their own. The 4 trillion club. Yes, Alphabet may be the quickest to reach within just 21 years, riding on the back of its search and Gemini AI services. And if it is also clear that this race to $4 trillion is fundamentally a battle between the ultimate AI infrastructure builders and also the established software and ecosystem giants. To give you a better understanding, I will talk about each of these one by one. Now, starting with the one who did it first, of course, is NVIDIA. Now, it closed above $4 trillion mark on July 10, 2025. It took them astonishingly only 26 years from their IPO to do so. Their rapid climb is purely a factor of being the AI infrastructure king. The evidence is overwhelming also in their recent Q3 fiscal 2026 results. Now, NVIDIA's revenue was a record $57 billion, up by 62% year over year. That growth is purely driven, in fact, by one thing. It is the data center. Next up, we have the cloud and software titans, which is, of course, your Microsoft and then Google, the Alphabet. In fact, Google, who is adapting at a lightning-fast pace to this changing tech climate. Microsoft briefly touched that $4 trillion, the elusive $4 trillion mark in July 2025. Their valuation is, of course, powered by Azure and their open AI partnerships. Of course, Alphabet, meanwhile, is sitting on top of its massively profitable search business while pouring resources into AI. In Q3 itself, Q3 2025, Alphabet achieved its first ever $100 billion quarter, hitting $102.3 billion in consolidated revenue. Their spending, in fact, is even more aggressive than Microsoft's. They now expect 2025 capital expenditures to be in the range of $91 billion to $93 billion. And finally, there is Apple. And it's the latest to hit the $4 trillion mark on October 28, 2025. Their path is a little different from others, built on, in fact, ecosystem and services, powerful, in fact, services division, and not just purely the AI frenzy. While not growing at an explosive rate of the other AI companies, Apple continues to generate vast, consistent cash flow from, of course, their iPhone ecosystem and its recurring revenue stream. To sum it up, the core risk is stark. Is this a sustainable, hyper-productive AI era, or a valuation bubble priced for perfection? The cloud titans, Microsoft and Alphabet, of course, are betting $100 billion in annual capex, win by capturing enterprise AI market going forward. Nvidia, in fact, is betting big on that GPU monopoly that they have and will enable it to profit regardless of which cloud titan prevails. Meanwhile, Apple is taking it slow. Apple is riding on enduring power of its $111 billion annual cash flow and, of course, their financial discipline. So, the battle for world's most valuable company is a wager on whose story, the AI growth engine, the infrastructure bet, or a profitable ecosystem will ultimately prove more resilient.
All right. Well, Shubhani, thank you very much for putting that story into context for us. Definitely, it is all about trillion-dollar companies now, because the four of the world's most popular tech titans, rather powerful tech titans, are now in a league of their own. They have reached $4 trillion worth of valuation. In fact, Alphabet, amongst all of those companies, has been the quickest to reach that within just 20 years. And that by riding on the back of its search and Gemini AI services. Well, with that, ladies and gentlemen, it's time's up for us here on Startup Central. Thanks for watching.